equity mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, our first interview of 2023. And our most interviewed guest?
Yes, well, we actually looked at this over summer. Simon pulled how many times experts have appeared on our show. And our expert today, Andrew Brown, we always start the year with Andrew, has appeared on the show 12 times.
Wow.
12 times 1 hour at my usual rate of $14,000 an hour.
Send the invoice. We'll
12 times. So back for the 13th with your bold predictions for 2023, Andrew.
Yeah, 12/8.
12, yes.
Yeah, lucky number 13.
Yes. So,
but before we do get into it, Andrew is also one of our most requested guests. I think on our Instagram comments over the break, people were asking, when's the bold prediction episode with Andrew coming out? And all I thought was, relax, I'm at the beach. It'll come into due time. But that is, we want to hear what you guys think. We want to interview the people that you want us to interview. We want to talk about the topics and learn about the topics that you guys want to learn about. And the best way to hear from you and for you to tell us what we should be doing is through the Equity Mates community survey, which is live now. The link is in the show notes. It's our opportunity to learn about the Equity Mates audience, to understand who you are, and most importantly, to understand what you want out of Equity Mates.
that's it. So you can win $500 in cash. There are also 3 runners-up who will win tickets to FinFest 2023. All you need to do is complete the community survey in full, and you will automatically go in. It shouldn't take you more than 10 minutes to complete. And it closes on the 28th of February. We would really appreciate if you took those 10 minutes to let us know how you think we're going and all things that Ren has just said. So, more info to come during this episode on FinFest 23 as well. But, Andrew, we finished the year last year, 2022, with a wrap of your bold predictions, most of which you actually nailed.
Yeah.
So there's massive expectations
which is
right
rare
now.
in the prediction game. Most people don't nail their predictions.
I don't mind admitting I'm more trepidatious about this particular pod than most others I've done.
Okay.
Not just because we did quite well last year, and obviously you want to repeat and do better, but since the year end, obviously markets have been rather strong.
Yes.
But look as though they may have peaked for the time being. Who knows? Just to give people an idea, at the end of last year, because we're not going to, if you're going to come and sort of say, well, at the end of last year, the S&P was 38.39 and you said X. Well, when we're making this broadcast, it's 4,017. So it's 7.2% above the year-end level.
So we're recording this on the 9th of February.
Absolutely.
Yeah.
And the NASDAQ is 14% above its December 31 level. So that's a whole year's return in kind of 5 weeks. And the ASX about 6.5% above that year-end level. So please, let's just bear that in mind, okay, when you kind of have a look and think through what we're talking about.
It is a really nice way to come back from the holidays.
I know.
And it's like, my portfolio is looking good.
Hell yeah.
Absolutely.
Let's close it out. All right. So, Andrew, you've got 14 predictions.
Yes, I do.
Great. Go for it.
I was wondering what you're going to...
I mean,
When I set thinking about this, obviously, which was towards the end of last year, I think it's fair to say the consensus view, if there was a consensus, and there wasn't a real one, but any kind of consensus view was that the first half of this year would be not so good for equities and it would rebound in the second half of the year, wherever it got down to and wherever it ended up. And that was a consensus. We were looking at recessions. We were looking at sort of rates that maybe had peaked out and everything else. So that consensus disappeared in the space of 5 weeks. Okay, that's changed completely in the space of 5 weeks, and it's changed largely on the back of a few words by Jay Powell in his first conference of the year. But I think what it shows, if nothing else, and this is prediction number 1, and it has a real implication for what you guys listening and girls listening have to do. Volatility is going to be a major feature of 2023. Okay, it was a reasonable feature of 2022. I mean, if you remember, the oil price was everywhere between 70 and 130, and there's about 2 months between the two. And what you've seen in the equity market this year, where participants got too bearish at the end of last year, and I would argue have got a bit too enthusiastic even already, just in terms of the speed of the rise. But it's going to mean that dollar cost averaging is really going to pay dividends for you this year. Okay, if you try and pick the bottom or pick the top, the likelihood is you get blown away. Okay, whereas if you just keep, putting your notional amounts of money into, each of your ETFs, if you're just using ETFs as an investment means, that's really going to pay dividends for you this year. I know a particularly smart individual who Ren also knows quite well, who lives in Canberra and has the surname Brown, who does dollar cost averaging, and his favourite stock last year was KWeb, which was a Chinese internet thing. Yeah, and that would range between 10 and 32.
Wow. And
the only way you were going to capture anything out of that was to dollar cost average, and that's what that particular individual did. And I think, if you take that on board, and I think that's what you're going to have to do this year. If you're going to get brave, well, you might win. I'm not saying you won't, but I think you're more likely to lose, to be frank. So that's prediction number one. Volatility will be a feature of 2023. Prediction number two is why might volatility be a feature of 2023? There are all kinds of economic things which we can get onto in a minute, but I'm going to suggest to you one of the boldest predictions I'm going to make is death.
Okay. Putin.
The three most important people in the world, and they do have an impact on markets, are Mr. Joseph Biden of Wilmington, Delaware, who is age 80, and the American actuarial tables tell me he has a 5.6% chance of dying in the next 12 months. He has a counterpart who claims to play ice hockey, but we haven't seen him on the ice for a while, Mr. Vladimir Putin of Mokba, or a cave somewhere near Mokba these days, I think. He's age 70, rumoured to be not very well. His theoretical chance of dying is 2.2%, but I think it's probably higher than that. And then the least likely dyer, but if he did die, it would be very interesting, is Mr. Xi from Beijing, and he's 69. Is it beyond the realms of possibility that one of those three may pass away? And what would be the implications of one of those three passing away? That's a real black swan left field, but nobody's thinking about it. But, one's not very well, one seems in great health, and the other is in great health for an 80-year-old in a land where the age expectancy for males is 77. I also have another death thing which may have less ramifications for overall markets, but it certainly would do for one particular company, which is I can't help thinking that there's a very well-known entrepreneur who was born in Australia, doesn't live here now, is 91 years old, and he has a 17.8% chance of dying in the next year, and his first two names are Keith Rupert.
Yeah. Wow.
And that would get very interesting because certainly we'll touch on News Corp later on, but I think that's a really interesting play for the year.
You say it'll have impact on one company and three democracies.
Correct.
Yeah.
Yes, absolutely. Yeah. So it's pretty fascinating. But I think world leadership, as you know, we've been in the thrall of one or other of these people.
Yeah.
Xi, and look at what happened in November. Xi just decided, China's been closed too long. The population are rebelling. Let's open up. And there's not an investment banker in the world isn't brushing off their China files and flying into Beijing and Shanghai. It's investment banking nirvana at the moment to try and see what can happen.
Yeah.
And, we know about Putin and, what's the alternative to Biden? Ooh. Haven't thought about that for a while, have you? Anyway, so there you go. So that's prediction number two. I'm sorry, one of them is going to go.
Wow. Okay.
And that'll have
That
a
would be
ramification.
interesting.
Yeah.
Or is going to be seriously ill and will be out of action.
Yeah.
Okay.
All right.
Three.
Let's get away from equities for a while. Okay. The one thing, everybody's talking about house prices, not just in Australia. They're talking about them in America as well. Okay. everybody's forgetting one thing about house prices and the issues with house prices at the moment.
That houses are for living, not for investing.
Oh yeah, they're utilities. They're not for speculative investment where you're geared 7-1. Okay. Number one, you are unwinding in Australia. You're unwinding decades of house price speculation. You're not unwinding a year or two. I know it's gone up sharply or did go up sharply from COVID, but you're actually unwinding decades before that, where the price to income is way above where it was when I bought a first house. I bought my first house paying 2.5 times my income, and people have to pay 10. Okay, but the issue is you take on so much debt, and even though that debt only costs maybe 6% now, and it's cost me 14, the cost to you at 6 is way more than the cost to me at 14 was, because I didn't borrow that much. Okay, and that's the fundamental problem, and that's been going on and on and on and on for quite some years. And the problem now is prediction number 3: the wealth effect is going to have a massive impact in Australia, unwinding this, and it's not going to be very nice, and it is going to have an impact on our economy. So I don't believe.
Just before we keep going, the wealth effect is when prices of assets fall, stock market or housing market, people feel poorer.
They feel poorer. It's housing tends to have a much bigger impact in Australia than the stock market does. In America, the stock market actually has a little bit more of an impact because Americans have more financial assets than Australians do, and Australians don't look at their superannuation every 2 minutes. And there's too much of their superannuations invested in property and infrastructure at crazy prices anyway. So the real issue is the wealth effect is when people just get demoralised because they're poorer, so they don't go out and spend because they feel poor. And they feel like they've got to stay in and watch maths and things like that.
Hey, what's wrong with maths? Let's not go there.
You wouldn't be saying it if I went on it, would you?
Well, shout out to one of our mates who we won't name, but we're trying to encourage to go on next year. So.
Absolutely, yeah. So I think house prices in Australia will not bottom this year. Everybody's looking for a bottom, and I don't think they'll bottom. Okay, because I think the wealth effect's so big, I think the lending environment's so crimped, and I don't think the current government have the same obsession with property that the prior government did.
So do you think it'll just be a slow decline?
Yeah, I think it'll just be the best bear markets are slow grinding declines rather than falling off cliffs. And I think you're just going to get every expert's going to predict it's bottomed, and it'll just keep grinding down. Okay. Because simply, the economics simply don't work for someone trying to go out and borrow money and buy a house. Okay. And it's now that the economics not working has come home to roost. Okay, because the banks are going to be under the pump. APRA is going to be looking. It sort of says to me the Reserve Bank are not going to drop interest rates. I'll give you 2 predictions on that as well.
Great. We did a bold predictions episode on Monday where we had 3 different people predict 3 different directions from interest rates. So we're interested to see where you land.
Yeah, absolutely. My 3rd prediction is that house prices in Australia will not bottom this year. House prices in America will bottom this year.
Okay. Yeah.
Great.
Okay? Different markets.
Yeah.
Okay, different markets. Bold prediction number 4. This is not bold at all.
Great.
Okay, this is not bold. This is about as consensus as you can get. Okay, but the date to watch is the 17th of September 2023. Okay, so my bold prediction is when we come back at sort of Christmas time and do the rerun of what happened to these bold predictions, Philip Lowe will not be the governor of the Reserve Bank.
Right, okay.
His contract finishes on the 17th of September, and I don't think it'll be renewed.
Yeah, I feel like that's...
And I'm rather more scathing privately that it shouldn't be renewed, but we won't go there.
If you want to be bold, do you want to call who gets the job?
I think it's going to be a complete outsider, and the reason I think I've mentioned this with you guys previously. If you go back, try and track down some of the stuff that Chris Joy released, okay, which was the Freedom of Information Act emails within the Reserve Bank when they were trying to work out why Coolabah, which is Chris's company, which had hired Peter Tulip, who built the Reserve Bank's house price model. Well, Peter Tulip was saying house prices are going down 20%, and the Reserve Bank, using the same model, or so they thought, said, they're only going to go down a sort of few percent. And they couldn't work out why Tulip was so negative and their model was saying something very different. And it turned out Peter had tweaked a few things, which is fair enough. But instead of actually reaching out to them, they spent months just sending emails to each other, trying to game and reverse engineer the model to absolutely no impact at all.
Right.
And so what it showed is the groupthink that is inherent within the Reserve Bank at the moment. And the review of the Reserve Bank, I hope, will bring out that groupthink, because it's patently obvious to me reading those emails. And they need to get rid of that. They need to have people on the Reserve Bank board and within the Reserve Bank that will challenge.
Yeah, okay.
And I mean, challenging not raising rates from mid-2021 onwards was a pretty easy challenge, and yet, 6 months later, we still had a 3-year bond target of 0.1, which is farcical. So that needs to be the challenge, and that's why I think Mr. Lowe has to go, and it means some of his cohort has to go. Sorry, but
that slogan could be printed on a T-shirt. Mr. Lowe has to go. So
it's actually Dr. Lowe, isn't it?
True.
Anyway. Oh, he's a nice man, okay, but he's just got it all wrong. I'm sorry. No getting around it. Okay, let's move on from house prices and the Reserve Bank. The really interesting thing is that the stock market is obsessed with interest rates. I am not obsessed with interest rates, okay? I think it is as plain as day where interest rates are going in America, and even to a degree in Australia, a bit less clear in Australia, but plain as day in America. Where are they going? They're actually they're probably going to go up slightly from here and then go nowhere.
Yep.
Okay, and then go nowhere. They are not going to fall this year. So bold prediction number 5 is the Fed funds rate will not be below 4% this year.
Nice.
Okay, it's currently above 4. It's it's close. It's basically
4.6.
4.6 at the
Something
midpoint.
like
4.75 I think at the midpoint. Okay, why is that? It's because you've been told categorically by Jay Powell, and to be fair by Philip Lowe, they're not going to stop until they crush inflation. If you want some reading, just Google Paul Volcker. Okay, and he was the Federal Reserve Board chairman in the early 1980s, and why he, ratcheted interest rates up so high, and why you need to crush inflation. Because if you don't crush inflation, and you'll see why I'm very critical of Philip Lowe in this respect in a minute, if you don't crush inflation, the impact that it has on your daily life is just horrendous. Okay, we can't live with inflation at 6, 7, 8%. Okay. Now in America, because of the construction of the CPI and because of what's going on in America, I am more confident that inflation can come down to sort of 4-ish fairly quickly. But to get it from 4 down to sort of 2 to 3, it needs a bit more of an effort. And that's why rates won't come down this year. And, they might go up once or twice more. But does that really matter? I think we can predict fairly clearly that the closing Fed funds rate is going to be sort of 5 and a bit. Okay. Does it matter if it's 5.25 or 5.5? Not really. Okay. As long as the long bond doesn't go to 6 or something like that. And if the long bond goes to 6, all bets are off. But I don't have that in my land at all. But I think the long bond will certainly be over 4 at one stage this year. It's currently about 3.7.
Why do you think when you say long bond, you mean like 10 years plus?
10 year, a 10-year Treasury bond in the US will yield over 4 at various stages this year.
Why if it gets to 6 are all bets off?
Oh, because it will destroy the 10-year Treasury bond in the US is the parameter by which virtually every other asset on the planet is priced. That's the ultimate risk-free rate. If you can get 6 off that,
stocks are going well down.
They're going well down, and that's not priced into the stock market. So I don't believe that's going to happen, but I do believe it will go up to reflect the fact that inflation will prove tough to get back to the 2 to 3% range. I think what this year is all about, if last year was all about, the repricing of money from zero to something, I think what 2023 is about is people's expectations of going back to QE, quantitative easing and zero interest rate policy and all that stuff. This is the year when it gets shaken out of them. And they realise that's not going to happen. Rates just don't get cut because the stock market goes down a little bit, okay? Rates are not going to really get cut this year, at all. And so I think the idea is that rates would be lowered towards the end of the year in the US and in Australia. It's just not going to happen.
So I think that's a really important thing for people to realise, that like the stock market isn't the economy and rates don't get cut because the stock market falls.
Correct.
Here's the question though.
Yeah.
In Australia, the housing market is the economy in some respects.
Yes.
Do you think if if everyone flicks over to variable rates, if there is a lot of mortgage stress,
Yep.
do you reckon that leads to a cut?
No.
Fair?
And the reason
Next question.
And prediction number 6 is that the Reserve Bank's cash rate will not be below 3% at any stage this year. Okay,
Yep.
that's a bit easy because it's currently
It's above that,
3.35 and it's going up. Why is that the case? And why am I so confident about this? Australia's inflation, if you look at the last inflation numbers, it's way more entrenched than US inflation. We have many more oligopolies in Australia, and it's quite clear they're gouging. I'm sorry, gouging is the Australian national sport, but we've been on the subs bench at it for a while because inflation's been low. Holy moly, major corporations were definitely in training. You don't need me to tell you who they are.
Well, I was going to say, do you want to name and shame any of them?
Oh, absolutely. I mean, the major food retailers are classics. I mean, you walk around even just the food aisle going, Jesus, when were nuts $15 for a 500 gram pack? Coffee's a classic. What's been going? Coffee prices are lower. The raw material's lower. And so all of a sudden everybody says, coffee's got to be $5. I admit staff are more expensive.
Electricity.
And electricity is more expensive. Rent should not be more expensive. It should be lower. But, Australian companies are getting really good at gouging again. They used to be brilliant at it in the 1980s. You used to go to presentations and like building material companies. The first slide was about price rises. and we back to that. We back to that rubbish again, okay? Now, that's a massive indictment on Philip Lowe, okay? Because what Philip Lowe has done, we've had this discussion before about demand pull, cost push, impacts on inflation. Cost push where, a third-party thing pushes prices up, like the oil price, for example. Okay, demand pull's just, when everybody wants tickets to Souths and East in the grand final and it's, there's no fixed price.
Yeah.
And the other one is inflation expectations. And getting that genie back in the bottle is really hard. And Philip Lowe's alluding to that. Every Reserve Bank statement now talks about inflation expectations. He's made stupid utterances about people taking wage cuts and keeping wage rises down and everything else. Inflation expectations are out the bottle in Australia now. We know it. Going back a year or two, if the price of something went up 5%, you had sticker shock. Now it's doubled and you just buy it.
Yeah.
Okay?
So this is my question though. If they say they have to crush inflation and get it back to that range that they do, and particularly here in Australia where it's so entrenched, it feels like rates are going to have to go a lot higher than consensus.
Yes, they are. Absolutely. If they're going to crush inflation, if they've got the fortitude to do it, and remember, we're talking about human beings here, no matter how well paid, have they got the fortitude to do it? Remember, in the US in the early 1980s, Paul Volcker, 6'8", cigar-smoking behemoth of a man, basically just blocked everybody else out and said rates are going up and up and up, and it shoved the economy into recession, but it killed inflation. And in Australia, you remember, the famous Paul Keating on the John Law show, the recession we had to have, and it was done with a combination of work between Hawke Keating and the trade union movement to get inflation expectations down, to stop index linking of stuff and accept below inflation wage rises for a period in exchange for something else. And the something else, of course, was the superannuation system we now have. Okay, do we have any other tricks in our pocket? Now, the unions are not as strong as they were back in the early, late 80s, early 90s when this was being done. But, it's a real problem when inflation expectations get out of control because you just pay the price and you don't care. And then you hope to recoup it from your employer in a pay rise.
Yeah.
And at the moment, you can do that. And that's not good. That's a horrible spiral.
Well, Bryce has predicted on Monday's episode that we're going to see higher than consensus interest rates. You think Australia will have a 6 in front of it?
Was it this? Yeah, America will have a 6 in front of it. Consensus is just over 5 at the moment. I think it'll get a lot higher. Australia consensus is just below 4. I think it'll go higher.
Yeah.
I think Australia will go much higher, and that's the problem. Australia's unwinding the mother of all housing bubbles. Yeah, way bigger than what's gone on in the US. Okay, it's unwinding a massive housing bubble, and people need to learn that gearing 8 to 1 on an asset doesn't go up all the time, and the demography's not there at the moment. I'm sorry, Indian students, coming back to Australia, or even Chinese students coming back to Australia, don't buy $900,000 houses in Sydney. Sorry. So there's some real issues here. The unbalance in our economy that's been wrought by, in my opinion, 13 years of politics and a bit of stupidity at the central bank is, it's not nice.
All right, we're almost
let's get off
halfway.
that.
Let's hit 7, then we'll take a quick break and jump back into it.
Yeah, hit 7. Okay, this is where I get a little bit specific. Okay, which is so the S&P 500's at 41.17 as I speak. Okay, that's 18.2 times the consensus figure of 225 for the calendar 23 year. It's too high.
The consensus profit figure.
Yeah,
so
profit figure.
like the price to earnings ratio of the S&P 500 as a whole.
is about 18.2. That's too high. So what I think is going to happen is I think that earnings projections are going to come down, but I don't think they're going to be as catastrophic as what some of the real mega bears have had. You've had guys talking 200 and 180 and stuff like that. Now, I would urge all the listeners to keep a track of where the S&P 500 earnings projections are, because that's what's going to drive that index, in my opinion. So I think what you're going to see is you're going to see weaker earnings as the year goes on, and I think that's why the index might hold up for a little while, but at some stage this year, it's going to go back and touch the lows of last year. Now, the lows of last year were just below 3,600. I think at some stage this year we'll have a correction of about 15%, and we'll see a low in the S&P around 3,500. And it's going to be driven by earnings expectations getting knocked back probably to around 210, which is only 4% below fiscal 22. So we're not talking Armageddon here. We're talking 4% below fiscal 22 because the economy's slowing, credit costs are going up, there's increasing unemployment against high-income people. Just look at what's happened in tech land. It's small numbers in the context of the overall economy, but they're highly paid people. Okay, so I figure that the market's better priced at probably 16.5 times a lower earnings number around 210, and as if by magic, that's 3,500. Okay, so I think you get a 15% correction from where we are at the moment at some stage over the course of this year. But I then think the market will start to focus on 2024. As it should do, and I think the market will have a more constructive view about 2024. I think the earnings numbers for 2024 are gaga. They're 250 at the moment, so cannabis clearly is being legalised in more states in the US than I think. But I do think that markets will start to look forward a little bit, and therefore prediction number 7 is after a 15% correction, I think the market will end up not too far away from where it was at the end of 2022. So the return over 2022 will be not much.
Yeah.
Probably, plus or minus a few percent. And I can see it at 3,800 again from a low of 35.
Yeah, so
Nice.
you think it will fall about 15% and then rise about 8%.
Yeah,
from
8
there.
to 9%.
Yeah.
Nice.
Yeah.
Keep
So we're not looking at a bear, a horrible bear market. Okay, I think there's too many people at the moment who've got extreme views about the US market. I don't share those. But I do think the market's too high. But that doesn't mean, we're in for a crash. Just because the market's too high doesn't mean we have a crash. It means we, settle back a bit.
But Andrew, you don't get your prediction published on the front page of Bloomberg by saying
exactly.
pretty chill year.
Yeah, we'll be down 3% for the year.
Absolutely. I think, as I say, if you bought on the 31st of December last year, then I think your return's going to be kind of meh. So.
Another reason to DCA.
Yeah,
and go
absolutely,
away.
and that's really crucial. Back to prediction one, you must DCA.
Yeah.
If you have a 15% downturn, you want to be buying some stock at the low.
Yeah.
Before you jump in, we're going to take a very quick break, and then we'll be back with Aussie. So let's do that. Now, Andrew, before we jump into the remaining 7 predictions, I did have a bit of a teaser at the start of the episode with FinFest 2023, and it is back this year. Andrew, you spoke at it last year. How to Make Money from Bad Breath was the title of your episode. I hope you have November the 11th in your diary.
I do.
Great. So
I do.
We're back at Carriageworks this year.
Absolutely.
Here
I'm
in
usually
Sydney.
at Carriageworks on a Saturday anyway.
Well, there you go.
Buying
There you
organic
go.
vegetables
'Cause they've got the
rather than
markets.
selling investment.
You're going to now get flooded on every Saturday at the Everly Market.
Absolutely.
So save the date, November 11th, 2023, Carriageworks here in Sydney. Registrations are now open for early bird access. We'll be releasing tickets in the next couple of months. If you're on the list, you'll get first access to early bird. Over 700 people have already put their names down, so it's off to an epic start, and we cannot wait to bring you a bit bigger and better FinFest for 2023. equitymates.com/FinFest.
Yeah, or the link will be in the show notes right next to the link for the community survey. Plenty happening in Equity Mates to start the year. But Andrew, plenty happening in the economy as well. We've got through 7 predictions.
Yeah.
7 to go. There was a bit of a teaser at the end of the first section.
Yeah.
Aussie. Where are we
Aussie.
going?
Where are we going? Let's have a look at the Aussie market. Okay. Yeah, the Aussie market did really well last year, remember? It was down 1%. That's all on the S&P, on the ASX 200. The domestic economy, I think, has real issues. As I've said, the way our CPI is constructed means it's not going to come down quickly. I think the numbers that were released in January were horrendous because the inflation was so broad-based, and I've explained that there's gouging. However, the index composition is 28% financials and 25% materials. So 54% of it is basically those two things which sometimes act in contrast to each other. But most of the major material stocks, virtually every single one of them is on a P of 10. BHP, Fortescue, Rio and Woodside. Okay, so unless you have a scenario where you think iron ore is going to collapse really badly, or the Aussie dollar is going to go through the roof, okay, because they're the things that drive it, and those two won't happen at the same time, obviously, then the resource sector, look, the first thing I learned about the Australian market, when somebody tells you to buy a resource stock on a P of 6, you sell it because it's top of the cycle, okay, and you buy on a P of infinity when there's no earnings. But the kind of resource companies we have now are not like the resource companies we had in the 1980s, which were very leveraged producers of copper and things like that. So these slightly more diverse companies and well-run companies, they're all on Ps of 10. I don't see a great return out of them, to be frank. Okay, because I think the iron ore price is quite high. I think I think the commodity is running into a bit of a headwind and everything else. But they'll probably do nothing much. And then you've got sort of 5 major banks. One trades on a P of 18 and is the world's most expensive bank because it's a seriously high quality bank. But that's too expensive. The others are all on Ps of 11 and 12, apart from Macquarie, which is not a bank, it's a gas trading entity. Most other gas trading entities trade on Ps of 6. It's on a P of 16, has surplus capital, and the CEO said the other day they're looking for acquisitions. Talk about arbitrage. So they'll be buying some more market makers or traders or things like that because they trade at twice the price they're going to have to pay. And so they'll have another uptick in earnings expectations down the track with an acquisition. But what that tells you is when your index is made up of banks on Ps of 11 and resource giants on Ps of 10, the whole index is on a P of about 15 and a bit. So what does that tell you? It tells you the rest of the companies on the market are on rather extravagant multiples for what they are. Wesfarmers is 23, Woolies is 26, Coles, they're 23. 26 times earnings for Woolies. Nah, sorry. So to be blunt, I think the index might end up sort of gyrating around a bit, but not giving you too much of a return other than your 4.4% dividend yield.
Yeah.
Okay. Simply because the top end of the index is sort of like, banks are not going to get blown away really badly. Okay. Their bad debt charges are going to go up. Okay, they're too low. I was looking at ANZ's what's called Pillar 3 disclosure, which is this like huge, big, long disclosure of where all their loans are and everything else. And I think they've got a $420 billion loan book, of which the provisions in the last quarter were $4 million.
Okay.
I mean, give me a break. That's rubbish. Okay. It's absolute nonsense. So there's going to be more provisions, but don't forget there's a lot of barriers between banks and bad debts on mortgages. Why? Number one is, don't forget everybody didn't pay, $900,000 for their house in Sydney. If they bought it 10 years ago, they certainly didn't, and hence they don't have a $900,000 mortgage. And so they might be stressing a bit and having a bit less money to spend on whatever it is, but they're not going to get forced out of their house. Number two, if they are forced out of their house due to really ordinary circumstances, well, there's so much equity in their house, even if the bank foreclose on it, the bank's not going to make a loss. Okay, and then thirdly, there's mortgage insurance, but the key word on insurance, which don't forget you pay for but the bank possesses, you pay for the bank to have the mortgage insurance, but the stupidity of it is the first law of insurance is never reinsure your risk with somebody with a lower credit rating than you. So if Commonwealth Bank is writing credit risk onto QBE and Genworth, they're nuts, because they're much lower rated entities than CommBank. So I think the Aussie market, bluntly, will go nowhere, but again, will probably go nowhere in a slightly volatile fashion because, bluntly, it just reflects a bunch of resource companies and a bunch of banks.
Has done for years.
It has done for years. So it doesn't, it doesn't really, your stock portfolio might reflect the economy and you might worry. And you wouldn't want to be economically exposed. I mean, you've really got to go through your retailers with a fine tooth comb, bluntly. So there you go.
Okay,
so
9.
That's Aussie. Number 9 is how you sort of think about individual stocks in your portfolio. I think it's basically going to be the rich get richer.
Again.
It's a continuation of 2022. If you have inflation at 6% in Australia and even at 4 or 5 in America by the time it comes down, I'm sorry, that's just no good for people at the lower income brackets, and it's brilliant for people who are wealthy. So the rich are going to get richer, and so what it means, in my opinion, is that there are going to be, the kind of things that the rich buy and play with are going to still be in demand. So, we spoke about Formula One in a pod at the during the summer series, and those kind of things. I've done a recent thing on luxury goods stocks.
LVMH.
LVMH I discuss but don't own, whereas I do own Richemont and I do own Swatch. Swatch is not Swatch watches; it's Longines and Omega. Those kind of high end goods, and I think those kind of things are still going to be very much in demand, and particularly as China reopens as well. So that's prediction number 9: is the rich will get richer. How do you play it? Think about how you play that in your portfolios.
Nice.
Number 10, we are going to have scandals. Okay, we're going to have real scandals. Okay, Australia, every time there's a real downturn in the economy, and every time it may have an impact on financial market assets, the general population and the government, particularly if the government happens to be Labor rather than Liberal, start gunning for some. They need some scapegoats, and the one area where I think there may be scandals is the valuation of unlisted assets. And that is meaningful because our superannuation funds have a big exposure to unlisted assets.
Yeah, okay, that's interesting.
It's more, for many of them, it's more infrastructure than commercial office property. So, there's a standard tease about, they've got all this overvalued commercial office property. Well, they have some, that's for sure. But, they paid rich prices for infrastructure, okay? With interest rates having gone up, that can't be worth the same, because it's a discounted cash flow of some reasonably certain income streams. So I think there's going to be a bit more scandal, and I'm not pointing fingers at not-for-profit super funds, because there'll be other people holding this stuff as well. But I'd be really surprised. And there's already sort of people starting to sniff it and inquire about it. But I think at some stage this year, just because it's the way things go when times are tough, that there'll be a lot more issue about the valuation of unlisted assets, and that'll lead to scandals.
Wow.
Because unlisted assets are valued by valuers and people in a smoke-filled room.
Well, that's been my question about private equity generally.
Absolutely.
They didn't really mark
Correct.
down
No,
last year, so it feels like this year they're going to be
They've
forced
got to.
to.
Yeah. It's always done with a delay.
Yeah,
And this is the year it comes home to roost. And that's a real problem, because if you have a lot, if you're in a super fund with a lot of unlisted assets and they haven't marked them down and you've been putting money in month by month by month, you've been paying overs for few months, quite a few months. So watch out for that. So number 10 is scandals.
If people hear that and they're like, well, I don't know, like, what am I meant to do? My super fund might be involved in a scandal. Any thoughts on?
Yeah, you stick to, look, on this, all these super funds publish reams and reams of stuff about what their exposures are to, each asset class and everything else. Most of them are very well diversified. So even if they've got 15% in unlisted rubbish, let's say they've not been particularly smart about it. Well, if that goes down 20%, that's only 3% off your super fund. And they've got all kinds of other assets that would make that up. If they've got 40% in overseas equities, which are up sort of, 8% already this year, well, there's your 3.
Yeah.
Yeah. So, don't panic, but do be aware of what's in your particular fund. Okay. And if you think there's too much of it, then, obviously you can switch to another fund, usually relatively cheaply. Okay. I don't necessarily, and this is not a dig at not-for-profit funds by any stretch of the imagination at all. But, there's a big difference between a not-for-profit fund and what I'll call a commercial fund. The commercial usually has a lot less unlisted, and some of the not-for-profits have gone a bit too far on the unlisted. And it's a matter of have they overpaid for the assets, etc. That's the real issue. But all you can do is have a look. If it worries you that much, I'm not trying to scare people here, but I think you must be aware of the fact that this is what's been going on. They haven't been marked down enough.
Yeah.
Okay. And it's not just a dig at property.
Yeah.
Okay. However, in that respect, prediction number 11 is we are going to see, in an environment like this where we've got an unwinding of asset price bubbles, we've got the price of money going up, and we've got some smart people with cash, that can only mean one thing: corporate activity. We're going to see a lot of corporate activity this year across the world. Okay? In Australia, the most obvious place to find corporate activity is commercial property.
Okay.
The disconnect, what you're looking for is disconnects between listed and unlisted assets, and the most obvious disconnect between listed and unlisted assets is commercial property. When the best REIT in the country, in terms of its management, in terms of the quality of its assets, in the commercial office property sector, trades at the biggest discount of any commercial office property REIT, something's a bit stupid. And that company is Dexus. Okay, they own things like 25 Martin Place. They own bits of Governor Macquarie, Governor Phillip. Their property portfolio is fantastic for an office property portfolio. And yes, we know all the issues about work from home and all that sort of stuff. Okay, but I think you get a once in a lifetime opportunity if you're a player, Blackstone, Brookfield, not-for-profit super fund conglomerate, to knock them off.
Just take them private,
Take
put
them
them in
private.
the portfolio.
You know, they're trading at about a 20 cent. If you unravel the gearing on the balance sheet, they're trading at a 27% discount to the valuation of their properties. And yeah, I think the valuation of their properties is too high.
So is bold prediction 11 Dexus gets taken
Yeah,
off the board?
absolutely.
Yeah, okay.
Yeah, and you get a $44 billion fund manager for nothing.
Nice.
For
At
nothing.
the current price.
Hold on, we should do it.
Yeah.
Absolutely. So I think Dexus or one or two others in the property arena will go. It's the year that some of that gets done. Okay.
Nice.
I think there'll be more financial services mergers. I think that's virtually inevitable as you know, harder times hit, then you know, somebody will sort of decide that you know they're just not big enough to play, and so there'll be more mergers in financial services, and there's bound to be more mergers in resources as well. You know, as people, you know, if you have a look at sort of, you know, things that have gone on in Western Australia in particular, where you've had zillionaires chasing Warrego, you know, and because it's strategic to what they want and need, and it's all about the strategic asset that sits alongside the thing you're trying to develop. So there'll be more and more and more of that going on, I think, in the resource sector. So that's to me. So prediction number 11 is basically Dexus will go.
Yep.
I think.
Yep.
The other one I think is as part of that whole thing. In corporate activity, and I touched on this rather nastily earlier on, is I think this is the year News Corp will finally unravel itself.
Oh, really? Okay.
I think the fact the Fox merger with News got knocked back. Rupert's 91. Okay, he's a very fit 91. Let's make that abundantly clear. But at some stage, he's looking at, you know, how does this pass on to the generations beyond? You know, remember, it's not just Lachlan; it's a whole bunch of other, you know, wider family members, and it's quite clear, you know, once you take out the stake in REA, the rest of the thing is woefully undervalued. It really is woefully undervalued, and those assets, the biggest compliment you can pay Rupert Murdoch and Lachlan is the way they've managed the other assets to really make them big earners now. You know, the whole Dow Jones Barron's businesses, which are, you know, now much more like kind of corporate suppliers of data, you know, as much as they are, you know, news vehicles, you know, in finance. Obviously, the book publishing side of things as well. You know, Foxtel's a lousy asset these days, but they've cleaned it up a bit. It's getting a bit better. You know, all that stuff. There's no way that stuff is worth what the implied residue once you take out REA is. It's worth far, far more than that. And I think, you know, if Rupert's starting to look towards, you know, the fact that, look, he ain't going to live forever, and he needs to bequeath something that's usable where the family don't squabble, then that's the best way to do it. What you don't want to do if you are an ageing entrepreneur is you don't want to leave a pile of arguments for your successors. And the best way to not leave the pile of arguments is to distribute some clean assets to them. And what you do, and News Corp is an unclean asset because it's full of things that have got different multiple ratings on. Yeah? And so the best thing is, and it doesn't matter if the kids sell their stake in REA, piecemeal, bit by bit, because there's institutions to buy it. Whereas if they start trying to sell their stake in News Corp, that won't work. Okay, so you split it off. That's the easiest way to do it. So that's why I'm fairly adamant about that.
Fascinating.
What was that? Was that a prediction? That was
12
that
or
was
13.
12, yeah.
That was at 12. If you're looking for contrarian plays for the 410th year in succession, Brown comes back to Equity Mates with maybe buy gold stocks.
Okay. Why this year? Inflation.
US dollar.
Okay.
Inflation's peaking out. US dollar might start to come down with interest rate expectations gradually changing. And so gold might do a little bit better. There's obviously some signs of corporate activity within the sector, as we know. So if you buy a gold ETF, you get the stocks, not the metal. So you've seen the play by Newmont on Newcrest.
Yeah.
So maybe gold stocks might do okay. I think you should have some in your little ETF portfolio.
Okay.
Okay. The other contrarian play, of course, which relies on the US dollar not soaring, it doesn't mean the US dollar has to crash, okay? But if the US dollar just stops soaring, then emerging markets should do better.
Yeah.
Okay, they should do better anyway because China's opening up. So how do you play that? Okay, so my completely off beam thing, which don't forget last year brought you Russia.
Yes.
Okay. And by the way, prediction 14A is my Russian stocks will trade again. They will be tradable again at some stage in 2023.
Okay.
Probably December
after-
the 31st after 8 p.m. at night.
After Putin dies, Ukraine win the war. Yeah.
You've got it. Yeah. So my suggestion to you, okay, and this is a market that's way off its peak, okay, and has had a few little scandals itself, but it is very, very interesting. And the way to do it is to buy an ETF, obviously. My suggestion is to buy the Vietnamese stock market.
Wow. Okay.
Okay. Now, the Vietnamese stock market index is, of course, like everything else in Vietnam, called the Ho Chi Minh Index. And it peaked out in, guess when, January 2022, like every other index around the world, at 1,516. And it's currently 1072. It's had about a 6% bounce, so far this year. So the index is made. There's quite a lot of real estate things in the index. Like the biggest stock in it's called Vin Homes, which does exactly what it says. And then there's a few other real estate companies as well. The second biggest company is obviously it used to be called Vina Milk, but it's the dairy company. And there's all sorts of slightly entrepreneurial things in there. But economic growth in Vietnam is starting to pick back up again. It had a couple of years where economic growth in Vietnam was only around 3%, okay, which is obviously due to COVID, okay, and last year was about 8%, okay, which is what you'd expect. And with China reopening, the kind of activity around the region, to me, it's, for something that's way off beam, way off its highs, an economy that just continues to grow because the average age of Vietnamese is about 25, I think it is, and the birth rate's high. It's a genuine growing economy, and when you invest in sort of frontier stock markets, in growth economies, you always have to compromise because you end up investing in what you would invest in any country starting from zero would be banks, media, land, builders,
resources,
stuff like that. That's been the model since year dot. I was lucky enough to be at the stockbroker that discovered Thailand, and Siam Cement was the biggest company on the Thai stock exchange at the time, and that's very logical. So I think Vietnam is really worth a look, in a very small way, obviously through an ETF, so you get the exposure across the economy. The Vietnamese banks can be pretty interesting, to put it mildly, but there are some of those in that. There's a few ETFs, so VNM, which is run by Van Eck, is one of them, but there are others. Just by the way, make sure when you buy a Vietnamese ETF, it's not chock full of unlisted exposures. There's 2 or 3 in London, but they're quite big unlisted exposures. And, I'm sure they're wonderful, but you really don't know what you're buying, whereas I'd rather buy something like the Van Eck one, which is just all listed.
Yeah. Great. All right. Well, that's an off the beaten path.
Yes.
And
Nice.
I think that takes us to the 14th. You've given us 14A, which is the Russian stocks will ride again.
Yes.
What's the rest of 14?
Well, that's pretty much 14, which is
Okay.
I think Russian stocks will ride again. Gold, emerging markets,
Nice.
Vietnam.
Great.
Okay.
As a play on that, I think that's 14A, B, and C if you wish.
Yeah.
So, there you
Right.
go.
Love
I think
it.
just as a general comment, don't get. Yeah, we are in a volatile environment, okay, and it's really easy for people to get on the front page of the paper, making outrageous predictions. The world's going to hell and the markets, the stock market's going to nothing and everything else, and house prices are going to nothing. And this is the environment. This is the environment you get that. Okay, so tear it up and use it as a bonfire. Okay, it's not worth what it's written on.
Yeah.
Okay, sit through it. Dollar cost average, because remember, the Equity Mates audience is young. You have years and years that if I'm wrong and it turns out the stock market has another 20% down year, well, it doesn't really matter. If you're dollar cost averaging, you're going to make it back up. Okay, but please don't assume just because the stock market had a down year last year that it'll have an up year this year. Just one thing to keep it on the straight and narrow, I should remind you the last 3 times that in 1929, in 2000 and in 2008, the stock market fell sharply even after we had a rate cut. So if you think I'm wrong and that we're going to get rate cuts, that does not mean the stock market's going to soar.
Yeah, that's
you
a
might
good reminder.
think it does because of what you've seen with interest rate expectations over the last few months. But eventually what happens is, of course, the earnings take over and drag the index down.
Yeah.
Don't also think that just because January was a bit of a bonanza that it means the rest of the year is a bit of a bonanza. January in 2001, I think at one stage the NASDAQ was up 23% and finished down 60% for the year. Okay, so there's some justification for the January effect. I remember 2018, by the way, which is much nearer. Okay, in January the market was up 9%, and then in 10 days in February it fell 12%.
Yeah.
Okay, so don't be surprised if we get that sort of volatility, but just DCA
Dollar cost
solves
average.
that.
DCA and go away. Well, Andrew, 14 bold predictions that we'll keep our eye on over the year, and obviously check back in December to see how it all went. But thank you so much, as always, for coming in, sharing your insights. Luckily for us, Ren, some of them weren't too far off what we were predicting. So,
Yeah.
Can I change them?
No, all good. But Andrew, as always, thank you very much. And,
No, my pleasure, my absolute pleasure. It's always a lot of fun doing this, and it does make you think.
It does
Yes.
make
It does
sense.
really make
That's
you
what
stop
we're
and
saying.
think. I
Yeah.
can't just come in here and roll it off the cuff. I
No,
have to do the homework.
Yes. Well, that's
Yeah.
what we said at the start of ours. If anything, it does make you sit back and actually have a think about what's going on. So, Andrew, I assume you'll be at FinFest. We'll take that offline, but make sure you jump on
Absolutely.
equitymates.com/FinFest if you want to hear Andrew in person live.
Or just duck down to the Everly Markets
Or
on a
just
Saturday.
Every Markets on a Saturday. But we'll leave it there.
Community survey link also in the show notes. If you could fill that out, that would really help us out. But we'll see you on Monday.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.